So within our business, there's multiple asset classes. They all tend to act differently. Historically, stocks would act one way, bonds would act another way. Real estate is a relatively stable asset class. It typically is not correlated, meaning it doesn't move up and down in value daily like the rest of the market. It tends to complement the other things that you do. Real estate is an important part of a portfolio. If we have somebody that's trying to draw income today in the current fixed income environment, really difficult to do that without real estate being part of what we select, because there's no yields really any place that are respectable for somebody that's retired. So real estate does three things. One, it gets you into a non-correlated asset class. It allows you to have a certain part of your portfolio that's stable, not moving up and down in value, and enables those people that need income to have a stable income stream, not dependent on the market. And I think if done correctly, it reduces your overall risk. Probably one of the most important things that it does, if done in the right percentages, and everybody is a little bit different. Until you know somebody's situation, their net worth, their income, no, there's never a way to answer a question everybody should. But I think as you grow your net worth and as you grow your income, certainly real estate as an asset class is helpful. You need to talk to an advisor about your own goals and objectives, but it can be very, very helpful. And especially as you achieve having a couple of dollars extra, because you've got to get your liquidity needs and your other things handled first. But when you get to building long-term wealth, it's a really important asset class. So one of the drawbacks, and frankly, a lot of investments, is understanding what does the liquidity look like? How do you get out? What makes real estate stable is you're not intending to get out in a year or two. With that said, the market over the last 3 years has probably had more turnover in real estate being sold than at any time I've ever seen. Real estate has gone up in value a little bit like we read in the news today. We had a 40-year record of inflation as it came out this morning. Real estate has a way of being more valuable at times as costs go up. You're seeing residential, the residential market's going up. That's going on in commercial, it's going on in industrial, it's going on in multifamily. So not all those markets are ever going to be equal, but they've been very, very strong. And what makes it not correlated, meaning moving up and down in value, you give up some liquidity, which is why you need to be very thoughtful of what percentage of your net worth goes into it. Liquidity could be money market you have in the bank. Most investment accounts that are even in stocks or bonds can become liquid within a day or a few days. Real estate doesn't necessarily work like that, and some of the things that we look at, we plan on it not being liquid for 5 years or sometimes even more, but that's how you get that consistent income stream. Because without the time frame of, let's say, 5 years or longer, you're not going to be able to have real estate do its job. It's not designed to be in and out in a year. It's designed to be a long-term asset class. One represents, what money you put into it versus what it's worth. The second is what rate of return it's providing. Most investments, their value is tied to what rate of return they'll produce over a period of time. Whether it's real estate, a bond, or a stock, its value is tied to what it'll produce over 1, 2, 3, 5 years. And things that produce a lower return are worth less. Real estate has to be where it's strong on the return side because you're giving up a little bit of liquidity, so you need some of those other features to help you. One of the other interesting things is certain real estate projects have depreciation against them called cost segregation, where they're allowed to depreciate against your taxable income. So for a lot of people, there's significant tax benefits where either it delays or sometimes can help limit taxes in an investment that's still not correlated. We think that's, again, tax ramifications matter to most people, so we think that's helpful as well.